Hello, everyone, and welcome to Gold Island's live investment summit today, hosted by Six. Today, I'm joined by Adrian Fleming, the company's CEO and director. Adrian is going to walk us through a company presentation, and after we're going to move on to a live Q&A session where we'll be accepting questions, and Adrian will be giving us answers. I'd like to remind everyone in the audience that you can submit your questions using the Q&A panel found on the right-hand side of your screen at any time during today's summit. And as always, this video is being recorded and will be available to watch afterwards on Six.com. But without further ado, Adrian, I'm going to kick things over to you and get us started.
Cam, thank you, and good morning, everybody. Well, it is morning here in New Zealand. So this is the subject of today's webinar. Not all gold deposits are created equal. And one of the reasons for choosing this topic was it's very apropos to Newfoundland, where we're working. Gold Island is a gold exploration company. We're still private. We've spent nearly $1 million on first-class exploration in Newfoundland last year, and the results of that work are coming in. We're very happy with those, and we're looking forward to a very vigorous exploration program coming up this summer. And just want to acknowledge our colleagues from Sixth and from Power Capital, who are important partners with us in our exploration activity. So here's a plan or an image of the island of Newfoundland in far eastern Canada. And I want to just refer to a couple of things on this first slide. The big yellow banners are the 7 properties that Gold Island has in Newfoundland, and you can see that they're named there. They're in different locations and all chosen in cooperation with one of our technical advisors, Shawn Ryan, who I've worked with previously. The other thing that this slide is intended to show you are recent discoveries and developments in this important new evolving developing gold province. And there are a number of companies that I've flagged for the purposes of this presentation. You can see them on the screen here, and then they're listed on the left-hand side. They include Matador Marathon, Newfound Gold, Labrador Gold, Maritime Resources, and Sokoman. Let's go to the next slide, which is a little table I put together, and I'm summarizing some of the key features of each of these companies that have gold developments or discoveries. So first of all, Matador Mining, a company out of Australia at the advanced exploration stage. Their property is called Cape Ray. It's one they have found on one of these major structures that run through the island of Newfoundland, a series of deposits. They've issued a resource estimate, their first, at 800, just a touch more than 800,000 ounces at 2 grams per tonne. And clearly, eventually, that will become an open pit mining operation. Marathon Gold have the largest identified resource on the island. It's called Valentine Lake. They are about to build a mine there. And their grade is just a touch under 2 grams per tonne. And so they will be developing a series of open pits. Newfound Gold, many of you will have heard of Newfound Gold with the Queensway North property. They're in the resource definition drill stage. Now, Newfound Gold is quite unique because they keep posting these very, very high grade gold intersections from their drilling. And clearly, eventually, that will become an underground gold mine. No resource estimate yet from Newfound Gold. Labrador Gold is on the same major structure as Newfound Gold, just a little bit up the road to the northeast. They've made 2 discoveries in the last couple of years. Big Vein was the first one. The next one was called Golden Glove. And these are similarly high grade to what Newfound Gold have found. So it's clear that Newfoundland has both a very high grade and lower grade mineralized systems. Maritime Resources with the Hammerdown project. This is a smaller deposit. They've identified around 900,000 ounces at a very respectable grade of 5 grams per tonne. It had been mined before underground, but Marathon have done a great job drilling up this system, and they're going to develop an open pit there very shortly, and they will truck that material to a nearby mill and be producing gold, I think, either later this year or next year. And then the last one I wanted to mention in this table is Sockerman, who have a project called Moosehead. It's at the advanced exploration stage. They're doing a lot of drilling, similar high-grade system to Newfoundland gold and Labrador gold, and no resource estimate from them yet. So for the balance of this presentation, I'm going to focus on Marathon and Newfound, and then I'm going to talk about some examples from Australia, New Zealand, and Canada to address this issue of the difference between gold deposits and why grade isn't necessarily king. It can be, but it isn't necessarily the case. So here's a slide from Marathon's website, and you can see that there's a number of different mineralized systems or deposits: the Berry deposit, the Victory deposit, the Marathon deposit, and one of the key controls to these orogenic gold systems are these major structural breaks, these cracks in the Earth's crust up which mineralizing fluids can migrate, and then they deposit in areas where there's open space. This gold showings were first identified here some decades ago, but Marathon Gold have done a lot of drilling and are moving towards developing a large mining operation. Here's a plan of the Berry deposit. And these lines are on 100-meter spacing. These red lines are the proposed open pits that they plan to exploit this deposit from. You'll see all of the drill holes on this plan, the drill hole collar location and then the drill hole traverse. And you can see these holes are between 25 and 50-meter spacing. So to define the 566,000 ounces at 1.6 gram per tonne here, Marathon have drilled 209 holes for 42,000 meters. So a lot of drill holes to define, touch more than 500,000 ounces of gold. And this is pretty common in our industry. My rule of thumb for the cost of drilling, once you get going, not the first few holes, but once you've got a drill campaign with some momentum, is it's going to cost you about $300 for every meter of drill core that you put in the core box. Maybe 350 meters, and the price, of course, continues to go up with inflation, etc. So to define this deposit, this system, that has cost around $22 per ounce. And that's a pretty respectable number, given what it's costing other companies and other places around the planet. But just look at some of these drill intercepts. They're quite wide. Look, 27 meters at 2.5 grams, 24 meters at 1.8 grams, 33 meters at 1.5. But here's an interesting thing. With each of these intersections, and I've just pulled these at random, you see a higher grade interval within the 27 meters. So 27 meters at 2.5 is the average, but there's 1 meter at 13.9. So that pushes the grade up a little bit. And what this is telling me is that there's probably several pulses of gold mineralization, and then a nice little pulse late in the event of gold emplacement that puts a bit of icing on the cake and pushes that grade up a little bit further. This is what the countryside looks like there in the central part of Newfoundland. This is a long section, so this is a slice. We were looking at a plan before, we're looking at a slice now. There's the scale, 200 meters, so the horizontal scale would be the same, about 200 meters there. This is the ultimate planned pits to exploit this deposit. And here's all the drill holes that they've done. And then here's some of the core from this lovely deposit. And look at that core. It is gorgeous. If my team later this year, and we expect to be doing some core drilling later this year, can return this kind of thing, we'll be getting very, very excited. So let's jump on now to Newfound Gold. Their project is called Queensway. And this is this very spectacular high-grade mineralization that they've managed to find. Well, firstly, with the Keats showing here, but these are these major structural breaks. This is the Appleton Fault structure. There's another major structure here. And like a lot of these mineralized systems in Newfoundland, it's not just one deposit. It's like pearls on a string. And so this is, there you can see several new discoveries here and then some more over here. But let's just talk about some of the bullet points on the left-hand side of this slide. Newfound Gold have already completed around 140,000 meters of drilling. They say that they're going to complete 400,000 meters at this very interesting project that they have. So if you use again my $300 a meter all up cost, which is assaying, geologist, support administration, all the other kind of stuff, that is $120 million in the ground to define mineralization at several targets. Here's a cross section. So I mentioned the Appleton Fault. So here's the Appleton Fault zone. These are not just narrow cracks. Look at the scale here. This thing is, 50 to 100 meters wide. So it's a major break in the Earth's crust. And there are several of these running across the island of Newfoundland. And within the properties that we, Gold Island, have, there are similar major structural features, which is where you sort of go because you feel that's a good place to look for gold mineralization. But let's look more closely at this cross-section. Here's where the gold mineralization is. It's not in the major structure. It's on what we call a splay. So you've got a major structure and then you've got a subsidiary structure coming off. So these are called first order structures. These are second order structures. And very commonly, and if you think about the Larder Lake, Kirkland Lake break in the Abitibi in Ontario, in Canada, you see exactly the same setting as this. So there are similarities to these families of gold systems. So these drill holes there, 10 to 12 meters apart. A lot of drilling is required to define these high-grade systems. And that's because of something called nugget effect. And nugget effect is just a term we use when you are working on a gold system that has a lot of coarse particulate gold. And let me try and create an analogy of what nugget effect is. So imagine you've got a loaf of bread, raisin bread, and you've put 4 raisins in, like raisins the size of my thumbnail, pretty big fat raisins. So we've got a raisin loaf, 4 raisins in there, and we've got 4 knitting needles. Imagine the knitting needles are drill holes. So we put 4 knitting needles through that loaf of bread. What are the chances of the knitting needles hitting the raisins? Probably pretty low. Maybe it would get 1 raisin, maybe none. So that's the challenge with these high-grade nuggety systems, is that you need a lot of drilling to define the shape, the size, and the continuity of the deposit. And that's why Newfound Gold, excuse me, compelled to do the very, very large drill programs. But look at some of these intersections, 88 grams over 3 meters, 56 grams over 2 meters. So these high grade systems tend to be narrow, but they can be very high grade. And this is a stellar gold system, no doubt about it. So here's a long section. Once again, just like I showed you with Marathon, this is a slice through the crust. So here's the Keats zone. We were just looking at the Keats zone, and these are raking chutes. They're not straight up and down. They can be at different angles. And look at all these drill holes. And then once again, in 100-meter blocks. So, they're down 1, 2, 3, 400 meters below surface. And as I was saying, not just one, Keats North, Golden Joint Dome, and Lotto. And then just to pull a few randomly selected drilling intersections, 19 meters at 93 gram per ton. At Keats, Golden Joint, 5 meters at 10. Lotto, 25 meters at 25 gram per ton. I mean, just blows your mind. Terrific stuff. But Newfoundland Gold have not put out the resource estimate, and I'm imagining that they want to complete this very big 400,000 meter drill program before they do. But let's speak hypothetically, just to play a game here. If in due course Newfoundland Gold say, well, we found 3 million ounces, and who knows what the grade might be, 8, 9, 10, 15 gram per ton, they've spent $120 million to define that. The cost per ounce would be $40. Marathon was 20, these guys 40, but that's not an unrespectable number. Okay, let's move on to a slightly different way of looking at gold systems and why there is a spectrum of gold deposits and grade isn't necessarily the most important thing. So I'm flagging AISC, all-in sustaining cost. Gold producers used to talk about cash cost, which was cheating a little bit because they weren't including administration, they weren't including sustaining capital and the other costs which are associated with any mining operation. So in the last decade or so, all-in sustaining cost, AISC, has become the benchmark or one of the key parameters that most, if not all, mining companies now use to describe their cost of total production. So this is data for Australian deposits. It's from 2016. It's still relevant, even though it's a few years old. And so just let's try and understand this chart. So these bars in grey are for underground mining operations. The ones in yellow are open pit, and the blue are for a combination of open pit and underground. And so here's the all-in sustaining cost on this axis, and then cumulative production, and the thicker the bar, the bigger the production per year. The lowest cost quartile down here is 875 Australian dollars an ounce. So a lot of companies would very much like to say, well, we're on the lowest cost quartile, where you should invest in us because we're making good money from our operation and we're low cost. So I'm quoting this in Australian dollars. And so to put it in context, in 2016, and this is 2016 data, the Aussie gold price ranged from $1,500 to $1,800. So if you were down here at 875 or less per ounce produced, you're making good money. The median was 1,056. The lowest cost small open pit operation was Rosemount at 640. So they're making $1,000 an ounce. Very nice, thank you very much. And the highest cost was Agnew in the Lawlers camp up here, getting quite old, that mine, and their all-in sustaining cost is $1,500. So they've only just got one nostril above water. So how does all-in sustaining cost relate to type of mine? Well, just look at this. There isn't any clear pattern because we've got open pits down here, open pits up there, a combination. So I think you can say that in terms of the grade of deposits and the type of deposit, there isn't any direct relationship between their profitability. And there's a couple of outliers here. Cadia and Boddington. Cadia is an underground mine in New South Wales. Boddington's a big open pit near Perth in Western Australia. We really shouldn't count those in this chart because they both have copper as a byproduct, and that copper helps to reduce their all-in sustaining cost. And Cadia, which is this massive underground mine with block caving, very, very large scale underground mining operation, has, this really, really low all-in sustaining cost. So that's AISC. Let's look at Aussie deposits in this next slide and focus on grade. So we've got gold grade here, And then once again, the the grey ones, the grey bars are underground, and the yellow bars are open pits, and then blue is a combination. So when you look at the grade of deposits, and this is mine feature, this is the grade that's going to the mill, it's a much clearer distinction, because all the higher grade deposits tend to be underground, and the lower grade ones and the ones that are both underground and open pit tend to be open pit mining operations. So for some reason or other, gold systems on this planet, if it's higher grade, it tends to be narrower, and so that drives underground mining. And if it's lower grade and wider, like Marathon, it tends to be mined with an open pit. So the median gold grade down here is just a touch over 2 gram per ton. Remember that Marathon was about 1 3/4 gram per ton. The highest grade quartile 5.5. The highest grade mine in Australia in 2016 was Gwalia at 10 gram per ton. Not that fancy compared to those terrific grades that Newfoundland Gold are delivering. And the lowest grade mine was Telfer in the Great Sandy Desert of Western Australia, open pit. And look at the grade, 0.9. And they're still making good money. So grade certainly has a definite relationship to the type of mine. That's a given. So let's look at some Canadian examples now. So here is a table from RBC Capital Markets. It's a selection, not all the mines, but a selection of mines in Ontario. And we're looking firstly at grade. So the lowest grade open pit mining operation in Ontario is Detour Lake, all in sustaining cost of $946. And this is US dollars now, not Australian dollars, US dollars, even though these are Canadian mines. And in 2021, this is 2021 data, the gold price ranged from 1685 to 1950. So at 946 all in sustaining cost, Detour Lake here are doing very well. The highest grade is Macassa, 19.2 gram per ton. It's underground. And interestingly, their all-in sustaining cost is just a touch over 1,100 US an ounce. So they're doing very well. The highest all-in sustaining cost, Red Lake down the bottom here in Ontario, 1,534. It's an underground mine. The grade is 6 gram per ton. Red Lake's been around for a long time. It's getting towards the end of its life, unless the Aussies who recently acquired it can find more mineralization. And so it's not generating that much profitability right at the moment. So let's look at Quebec. This again is information from RBC Capital Markets. And this is just a snapshot, a few of the gold projects in Quebec that are in development. The highest grade, Cisco's Windfall Lake, 9.4 gram per ton. They say it's going to be an underground mine. They've completed the feasibility study. They're moving through the permitting process. And look at this number, 660 US dollars an ounce. So they're going to make a lot of money, and a huge amount of drilling has gone into defining the resources for this system. The lowest grade is Marban Block. It's an open pit, 1.2 gram per ton, but once again, all in sustaining cost, 822. So once again, looking at, what are the relationships between grade and profitability, there's such a range of different styles of mineralization, widths of gold in the ground, and mining approaches and infrastructure and various other things, so that it's hard to draw clear-cut relationships for some of these parameters. Let's look at a couple of bubble plots. So this one all-in sustaining cost again, and production in 1,000 ounces of gold. So what is this over here? Well, that's Detour Lake and Malarctic. And on this chart, they are outliers. I mean, they're way over here on the right-hand side of the plot. Underground are blue and open pit are grey. And we've already talked about Detour, but it is a monster producing around 700,000 ounces a year. And as we saw, very profitable mining operation. And so on this bubble plot, there is some order, because these are the underground ones. Their all-in sustaining costs tend to be higher, and the open pit tend to have lower all-in sustaining costs. But it is grade determined to a degree. The next bubble plot is looking at grade versus contained ounces. So grade on this axis and contained ounces here. And again, these monsters, in geological parlance, we call them giants. The very few large mineralizing systems on the planet are regarded or labeled as giants. So Malarctic and Detour are giants. Detour with, resources heading for 30 million ounces. Malarctic, 18, 19, whatever it might be, total inventory. These are anomalous systems, but if you could find one of these, it would be terrific, because, they last for a very long time. And more often than not, they're very efficient mining operations. So again, blue is underground, grey open pit, and there is a pattern here. There is some order to this distribution of deposits, and it's just a selection where the higher grade deposits are here, and the lower grade ones open pit, higher grade underground, lower grade open pit. And so that's a pattern we see in many places, and we see it in Newfoundland, because Newfound gold is clearly going to be principally an underground gold mining operation, and Marathon starting off open pit. So I started off saying not all gold deposits are created equal, and not all gold ounces are created equal. So what are some of the takeaways from this quite high level analysis that I've tried to present to you today, and using Newfoundland as an example to describe these relationships? So I think the first takeaway is that between gold grade and cost, there's not a linear or a direct relationship. It's kind of all over the place, as you saw from those couple of plots I showed you. The style of mineralization is much more important in determining profitability and the kind of mining operation. So these narrower, higher grade systems, you've got to mine them underground, because they just won't work with an open pit, because very quickly the strip ratio, the ratio of waste to ore, is going to kill the economics. Cost of production is a key component to all-in sustaining cost and type of mine. And as a rule of thumb, an underground mining operation will probably cost 4 to 5 times the amount per ton of rock dug out and delivered to the mill than an open pit. So it's not uncommon that the all-in cost per ton mined, not all-in sustaining cost, all-in cost per ton mined for an underground operation might be $80 to $100 a ton. Open pit, $20 a ton. So you need 4 or 5 times the grade of an open pit mine if you're going to go underground. So 1.7, 2 gram per ton, 2.2 gram per ton is pretty common in open pit mining operations, and 6, 7, 8, 9 gram per ton, pretty common for underground mining operations. And scale of operation is also key. So a an open pit mine, you can mine many more tons per day than you can with an underground mine, unless you go the Cadia route where there's this enormous block caving system underground. So I've been chatting away here for a while about different styles of gold deposits and related topics. But what's the point here for a company like ours? Gold Island, still private, listing later this year, spent $1 million on exploration last year in Newfoundland. We like the results we're getting, and we're gearing up for a very, very vigorous exploration program this year, 22. And our goal is to make a discovery, but to make a discovery that eventually will be viable. So if it's going to be an open pit, it needs to be 2 grams or so. And if it's going to be underground, it's got to be, 10 grams or better would be ideal. So this kind of analysis is relevant to our thinking about exploration targeting, about our exploration strategies, and the potential economic attractiveness of what you see in the first few drill holes, which have indicated to you that you've made a discovery. So you might say, well, Adrian, okay, you're leading the charge of this company, Gold Island. What kind of deposit would you like to find? Oh, me? Oh, okay. Well, I can't tell you what we're going to find. Clearly, what is there is what is there, and we're going to go through our very systematic process to try and find a new gold system in Newfoundland on one of our projects. Would I prefer a marathon type system or a newfound gold type system? I think I'd actually prefer to find something like Marathon have, open pit, around 2 grams per ton, because it takes less drill meters to define a deposit like that, and the capital cost potentially is less, because with an open pit mine, you scrape off the overburden and you start digging rock and sending it to the mill. With an underground mine development, you have to put down declines or shafts, and there's quite a lot of capital and infrastructure and other activity, and in addition to the mill that you've got to build to be able to produce bricks of gold. I would be happy with either. I'd be happy with the marathon type or with a newfound gold type. So we're commencing our exploration work. We've done some already. We're looking to a very vigorous program this summer, including quite a lot of drilling, RAB drilling first, and then moving to core drilling. So we'd like you to join us in this journey. Subscribe to the shares when we go public later in the year. And it's a treasure hunt. It's exciting. Join us in our hunt for treasure. Thank you.
Wonderful. Well, thank you, Adrian, for the great presentation. We'll be entering the Q&A period now. I'd like to remind everyone in the audience that if you have any questions for Adrian, feel free to pitch them using the Q&A tab found on the right-hand side of your screen at any time. Adrian, we've already got a couple of questions coming in. First question, shouldn't Hemlo be in the giant class, including historic?
Hemlo, yes. Hemlo probably is or was in the giant class. Hemlo's near the end of its life now. The history of discovery of Hemlo was pretty exciting, because I think it was like the 100th drill hole or the 90th drill hole in that area before they hit. But yes, Hemlo certainly is eligible to be in that category, and that's a good question. Thank you.
Oh, fair enough. Another question, are you currently raising capital right now?
No. Our friends from Power One and Eric Sprott put a bit more than $8 million in the bank back in the third quarter of last year. And we are planning our current activity. We've got nearly 8 million in the bank at the moment. Our current plans and budgets are to spend about half of that money in 22, and then another half of those funds in 23. But our goal is to go public, probably in Q3 of this year, and we expect to top up the treasury. And then on the basis of the results from our field work, which is about to start, perhaps we'll commit more money to exploration in the ground.
Okay, thank you for that. A question regarding the long term now. You mentioned building a mill, but since Newfoundland is growing such a proposition, wouldn't there be an opportunity for multiple mines to share a milling facility? And is this being investigated at all by anyone that you know of?
Yes, there is. I mentioned Maritime Resources with their Hammerdown project. That's an example of exactly what the question asked, because there is an existing mill that is processing, it's owned by Anaconda. It's processing material from a couple of open pits, and the Hammerdown material will go to that mill. So yes, sharing different sources of gold going to a common mill is, that you see that in Chibougamau, you see it in some parts of Western Australia, and it is an option for people who make discoveries. But if you've got a very large deposit like Marathon have, they probably don't have any spare capacity in their mill. So we've got a project, Blizzard, which is just immediately next to Marathon. If we found a deposit there and we went and knocked on Marathon's door and said, hello there, can we send some of our rock, all of our rock to your mill? They'd probably say, guys, go and build your own.
Oh, fair enough. All right, Adrian, next question. It's regarding your involvement in the discovery of the white gold deposit in the Yukon. How does it compare with the deposits that you've been talking about today?
Yeah, that's a good question. White gold is not a mine yet, and I hope it is before I'm dead. Not that I'm planning to die anytime soon, so white gold is an intrusive hosted system. It's in what formerly was a granite. The rock is very fractured, and the mineralization extends over quite wide intervals. I think the best drill hole we returned was 300 meters at a touch over 2 grams per ton. So there was a very steep drill hole through the thickest part of the system, and there's 300 meters of fairly continuous mineralization. So it's a little bit like Marathon, and because the grade is just a touch over 2 grams per ton. But I think the difference between white gold and say Marathon, just to take an example, is that the grade in Golden Saddle was very consistent. It's just 2 grams, 2 grams, 2 grams, 2 grams, 1.9, 2.3, 1.7, remarkably consistent mineralization through a very large body of rock. That deposit now has total resources of, I think, about 1.5 million ounces. And it's not a mine yet because it's fairly remote, and there is no road near to it, and there's no power near to it. But a sister deposit, also found on the back of Shawn Ryan's early work, called Coffee, owned by Newmont, which is about 20 kilometres to the south of Golden Saddle, has recently received its environmental permits, and Newmont are going to be moving to build a substantial heap leach project at Coffee. And with that development in the pipeline, Golden Saddle, which we found in 2009, will undoubtedly, I hope, become a mining operation in the next few years. And that deposit is now owned by a company called White Gold.
Okay, thank you for that. A question about a term you used, nugget effect. Do you mind elaborating on what that means?
Right. Yes. Okay. Nugget effect. Many gold deposits, when you look at the rock in the pit or underground, you can't see any gold. It's not visible to the naked eye. You get your hand lens out and maybe have a look, and perhaps you can see it. So the size of gold particles within a gold deposit is like many things. It's a spectrum from very, very, very fine grained to the kind of thing that Newfound Gold and Labrador Gold are uncovering, which is big specks, like big grains of pepper. or chili flakes in some cases. And so the larger the particles, the more difficult it is to define the grade, because a drill core is, 50, 60 millimeters in diameter. And I was giving you the analogy before of, raisins in a loaf of bread. So the larger the particles, the more samples you've got to collect to get a representative idea or an accurate estimate of the quantity of gold and the continuity of it. And diamonds are perhaps the extreme example of nugget effect. Now, diamonds aren't any good unless they're big enough to put on your fiance or your partner's finger. And so when you're exploring for a diamond deposit, you start off with drill core, but the nugget effect is extreme because you hope you're finding larger diamonds, and they're very few and far between. And so it's very common in diamond exploration that you do your drill phase first, and then you actually take out a sample, maybe a couple of thousand tons of material, and put it through a mini processing plant. And you've got to do that before you can define the resources of that particular diamond kimberlite bearing pipe. So nugget effect is about particle size, and the bigger the particles, the more difficult it is to accurately determine quantity and grade.
Well, thank you for that.
I hope that helped.
Yeah, absolutely. Thank you. What's the best drilling method to define a gold deposit? Is the next question pitched to you.
Yes. It's interesting that drilling technology really hasn't evolved very much during my 4 decades in this business. Core drilling or diamond drilling, which is a circular bit that cuts down through the rock and gives you a tube of or a rod of rock, has been a method that is still used. It's relatively slow. You might drill 30, 60 meters a day. So that's one method. Another method is reverse circulation drilling, and reverse circulation drilling has evolved during my career with different types of bit configurations, and it is faster, but it has the drawback in some cases of smearing the gold mineralization in the hole. And of course, rather than a stick of rock that you can look at and test and cut in half and send half to the laboratory, with reverse circulation drilling, you finish up with chips and dust. In Nevada, most gold, and Nevada is a very important gold producing province or state in the world. Most of the drilling that's done in Nevada is actually done with reverse circulation techniques, because the rock is very broken, and core drilling tends to get into lots of trouble because the rock is not competent, and it breaks up and causes drilling difficulties. So for the sorts of gold systems that people are finding and developing in Newfoundland, core drilling is by and large the default way to go. But there's a little bit of a mindset here, I think. And so in the early stages of exploration, reverse circulation drilling can be very cost effective. And I think there's a place for both. I don't think you have to do only core drilling. Probably with something like the high grade system that Newfound Gold have got, you really have to do core drilling there, because the RC just won't be very effective. There is work going on to look at developments in drilling systems. So instead of having rigid rods, you have a rod system which is continuous, like a pipeline on a big spool. But drilling is relatively slow, and it's relatively expensive. And one of these days, perhaps somebody will come up with a laser system or something like that. Will just burn a hole through the rock, and then you put a probe down, and that gives you an instant analysis. That's not with us yet, but people are looking at new methodologies as they should do.
I mean, that'll be certainly interesting. Another question coming in, what methods is Gold Island looking to use to find a new deposit in Newfoundland?
Yes, we're following a pretty conventional pathway with our discovery. Of course, you start off by selecting areas which you think are prospective, and that has been largely done for us by our colleague Shawn Ryan, who I worked with in the Yukon back in 2008 through 10. And Shawn has been very active in Newfoundland since 2016, and a number of companies have optioned ground from Shawn's pioneering work. He does very careful research, looks at past exploration activity, looks at geological maps and other things, and defines where he thinks it's the right terrain to look for gold mineralization. And in Newfoundland, clearly these major structural breaks that are running across the island in a northeasterly direction are important places to look. So the first step is pick the area you want to work on, and we have several, as I pointed out in the talk. The next method is you need some sort of first pass analysis, broad scale over all your property, to find where there are suggestions, or if you like, sniffs of gold mineralization. And so what we are using is systematic soil geochemistry. It's a method where you dig down to the sea horizon. There's A, B, and C horizon. You take a sample, a couple of kilograms, that goes to the laboratory, and they give you a gold analysis plus a bunch of other elements, because there's often pathfinder elements associated with gold. So choose the area, do your first pass work. That is often supported with some geophysics like airborne magnetics or electrical geophysical methods. And so from those early steps, you hope, and we have already, some good indications. And so then the next step is you go back and you do additional sampling, because you start off with broadly spaced lines, sample every 25 or 50 meters. You've got to go back to where you're seeing some smoke and do some additional sampling. And then once you begin to define a cluster of anomalous gold grade samples from the soil, or maybe you find some outcrop and you can bang off some pieces and send them to the laboratory and they're running 4 or 5 grams per ton, then the next step is some sort of drilling. And what we plan to do is drilling in 2 steps. We're going to use what's called a RAB drill, rotary air blast. It's a bit like a quarry drill. It's small, it's not that expensive. We're not trying to drill deep, 20, 30, 50 meters. And so a series of drill holes in this area where we're seeing some surface indications with this quick first pass drilling. And then if that gives us encouragement, then go to the core drilling method. And as you saw from the 2 examples I showed in the talk, Marathon and Newfound Gold, some hundreds of drill holes are required to get to the point where you've identified a resource and a reserve to a level of confidence that the engineers can come into a feasibility. You go to the bank and say, I want $700 million to build a mine here. Thank you very much. And then we, geologists, exploration people, we fade out of the picture because we've done our job. We've found a deposit. We've defined what it is. And now somebody else is building the mine. So it's a process of steps. And each step provides some information, and you use that information to determine the next step that you take. It's a progression.
Okay, well, thank you for that. We received a question in advance of today's summit for you. How important is existing mining infrastructure, such as roads and power availability, in assessing the economic viability of potential developments?
Very, very important. And this is one of the reasons why Newfoundland is such a great place to be doing exploration, because it's in Canada. It's a developed country. It's got a very good mining legislation, so you know the rules of the game, and they're not likely to change them. And it's a mining-friendly part of Canada, overlooked, I think, in terms of modern gold exploration. But to specifically answer the question, which is about infrastructure. So Newfoundland's got roads all over the place, plenty of power, lots of little towns, services, cell phones, all that kind of stuff. So it's an easy part of the world to work in. I've worked in places where there's essentially no infrastructure whatsoever, and that makes that drives the need to find higher grade or bigger mineralized systems. And I think a good example, in the early part of my career, I worked in the mountains of Papua New Guinea on a project called Porgera. I worked for a company called Placid Development in those days, out of Australia. And we found a large deposit. It had been identified several decades beforehand, but we went in there and did a lot of drilling. And I think we came up with about 2 million ounces at 3.5 grams per ton, open pittable. The gold price in those days was about $800 an ounce. And that project was nowhere near to being viable because there were no roads, there was no electricity, there were no towns. It was in a very remote area in the highlands of New Guinea. And so the joint venture, which consisted of 3 companies, Placid being one, and we were doing the work, the joint venture said to us, the geological team, well, you've got to find more and it's got to be higher grade. And we said, oh, okay. So we went back and started looking at all the data and found an area where we hadn't been doing any work, and went back there and said, oh, some interesting stuff here. And after 2 campaigns of drilling, we found a zone called Zone 7, which had newfound gold type grades, 20, 30 grams, but not over 2 or 3 meters, but over 15 to 20 to 30 meters. It was just an incredibly rich mineralized system. And so because it was so high grade and so large, that was able to pay for bringing a road in, bringing power lines from a hydroelectric system and gas field several hundred kilometers away. So, and white gold is very similar. The Golden Saddle deposit we found on the back of work by Shawn Ryan in 2008, 2009. There is no road right to that deposit. There's no electricity to it. You've got to cross 2 very large rivers to get there. And so when we were exploring it, we used the Yukon River. We used to travel up and down the Yukon River. There was an airstrip nearby. Much of our equipment was brought in by aeroplane, and we used helicopters. And so that deposit and coffee, notwithstanding having been found 15 years ago, have only just recently with coffee been committed to development because of the lack of infrastructure. And in many places in developing countries, there's a lack of infrastructure. And so you've got to find a bigger, better one in an area where there's limited infrastructure to make a mine. Whereas in Newfoundland and much of Canada, which of course are great places in the world to explore, all of that, roads, power, water, workforce, facilities, towns already exists. So it makes it much, much easier. So that's a bit of a long-winded answer, but I thought I'd just throw in a couple of the projects that I've worked on to try and illustrate the critical importance of infrastructure to mine development.
No, absolutely. I think it gives good color. Listen, Adrian, now before I hand things over to you for some closing remarks before we wrap up for the day, as we only have about 6 minutes left, I want to thank everyone who's come in today and attended, especially those who have asked questions. And of course, I'd be remiss not to thank you yourself, Adrian, for coming on today. But back to the audience, if you didn't get a chance to think of a question and ask it, or if you think of one afterwards, you can, of course, reach out to the Gold Island team. They have contact information on their website, goldisland.ca. But Adrian, thank you again, and over to you to close us out.
Thanks, Cam, and thanks, audience, for listening to what I attempted to tell you about today. I think we're having another one of these in 3 or 4 weeks' time. I think in April, can't remember the date now, maybe it's the 20-something of April. And I'm going to have a panel discussion with Shawn Ryan, myself, and a guy called Rob Carpenter. And we're going to talk about greenfields discoveries. We're going to talk about the Golden Saddle discovery in the Yukon back in 2009. We're going to talk about the coffee discovery in the Yukon, which Rob Carpenter, a colleague geologist of mine, led the charge on. And then going to talk about Shawn's work in Newfoundland, because what Labrador Gold have found, again, is on the back of Shawn Ryan's very systematic geochemical and research approach. So I'm looking forward to that panel discussion and hope you can join us then. And thanks a lot to you, Cam.
Well, thank you so much. And with that, we'll be wrapping things up today. Hope you have a good rest of your day, Adrian. Cheers.
Thank you.